We love having you on options expiration day because this is in your wheelhouse here. And we know there is violent moves related to options, sometimes on these triple witch, call a quadruple witch, whatever you want. Some people will absolutely refuse, like Joel, to call a quadruple witch, but we call it triple witch. I mean, one, just explain, what exactly triple witching is to our audience who haven't heard it. We titled the show Witching Day, so maybe we'll take a chance where our options expert can explain that a little bit. And then two, explain how maybe you approach a day like this.
Yeah, so triple witching, I always refer to it as triple witching. That's what it used to be called. They tried to make quad witching a thing, but the fourth product isn't very popular, right? It was single stock futures, right?
Yes.
So basically what it refers to is, happens 4 times a year where a bunch of the expirations and settlements all happen on the same day, right? And they tend to be that day itself, the witching term comes from like kind of the weirdness you see, right? And you mentioned it earlier, Dennis, like the open is weird. You might see some like imbalances that you wouldn't have seen on a normal day on the open. And then you have this kind of, the unwind starts a couple of days before, but it really accelerates into the close. And that's a lot of traders and big hedge funds and, mutual funds rolling options positions and things into the next month. And you see a bunch of weirdness. You see whatever environment in the options backdrop that existed that week starts to switch over and you get a completely new one next week, right? And then I think on top of that, I think there's an S&P rebalance, at the close. So you see that after hours, that 15 minutes can be really weird at the close. And then of course that last hour is very weird. So, as a trader, you have to be careful, or maybe even like the way you said it earlier, Dennis, you look for some opportunities on the open, or you look for some weirdness into the close where you might not have seen that otherwise. But from a bigger picture, kind of, looking ahead the next couple of weeks, looking into year end, the bigger news story with a big expiration like this, and this one's massive, and it's one of the biggest you will see. Basically, to put it into kind of the backdrop of options in the market terms, about 1/3 of the options positions that exist and the effect of those options positions goes away into Monday morning, right? So, that backdrop changes Monday morning, and next week historically is a terrible week, going back decades. And the week after September expiration and that triple quad witching expiration, I think it's only been up a handful of times in the last, like 30 years or something like that. So it's historically, we always talk about September and October being historically weak. A lot of it has to do with this. And, I could go on forever about this, but if you think about summer trading and summer volatility and low market volatility, we of course saw August volatility, but people start to position ahead of time and they look out to like September options and October options. And this year you throw in an election into that mix too, right? So people start to position for potential volatility into the fall. On top of that, this week we had a FOMC meeting right into this expiration. So you think about all of that option positioning into that FOMC meeting and into this expiration. And it even explains a little bit of the rally yesterday. I think I put something in the chat, like remind me to talk about this a little bit, because on that question on the rally yesterday,
sure,
going into the FOMC meeting, so the way the options complex generally looks in the big ETFs and the indices and things is people buy puts lower than where the stock is trading, lower where the indices are trading, and they sell calls above where the indices are trading. It's one giant moving collar generally, right? And a collar is, if you wanted to collar a stock that you owned, you'd sell an upside call and you'd buy it. You'd use the proceeds to buy a downside put, right? So imagine all of that with all that volatility we saw over the last month going into this FOMC meeting where it was a coin flip what they were going to do, right? Like it was 25, 50, like nobody really knew.
Yeah.
Imagine all of that positioning. Okay. So now you get the initial reaction on the FOMC day, which was, a little bit weak, but not anything horrible. Then the next morning we gap higher, right? That is a lot of people saying, all right, well, we didn't get this panic sell-off on the FOMC meeting. I'm unwinding all of my protective puts and I'm going to start rolling my upside calls out, maybe to the next expiration or anything like that. And so all of that backdrop in the options market and a lot of that rally yesterday is a lot of people just basically getting out of their protective positions into the FOMC. And that puts upward buying pressure on the market on a day like yesterday. It's like all those market makers, my old job. I'm having a bunch of people sell puts back to me, right? And they're buying the calls back that I was long, right? And so it's sort of like it kind of puts all this like pressure, upward pressure on the market out of nowhere.
So you're saying next week, though, all that upward pressure out of nowhere is gone. So we start with a clear slate here, so that opens it up a little bit.
Exactly, and that's generally why, next week. Again, that historical record is really a negative one. That's not necessarily what will happen. I think the way you just phrased it is the perfect way to phrase it. It just opens it up. We could see a bunch of people come in on Monday and be like, I think we're going to break out new highs and everything like that. And then the options resistance of all of those upside calls that everyone has sold, a third of them don't exist like they did yesterday. You know what I mean? So you could do the opposite. Now, generally, opening up in fall, we've got an election coming up, all that stuff, right? And we're at all-time highs. Like, that generally historically could mean downward volatility, but it's not guaranteed. It could mean upward volatility. But we're likely to see some volatility next week. And then, to be honest, there's no real reason in sort of the VIX futures curve and the options complex in general is pretty much predicting not super high volatility because the VIX, you can see it at 16 right now. It's not high. But the VIX futures have been bid up and options have been bid up into the election for months now, going back to the spring almost. So that kind of environment and that kind of backdrop is likely to continue where it might be two-way volatility and it might be a really tradable market over the next, month and a half.